Welcome to eOptions webinar. We're happy to have you here with us, and thank you for taking the time out of your day to join us. We've partnered with the Options Clearing Corporation, or OCC, today to bring you this webinar on bullish and bearish options strategies. My name is Gina Bocayas, and I'm with Regal Securities, which is the parent company of both eOption and InvestTrade. And to give you some housekeeping items of the webinar, the session today will last approximately 1 hour. If you have any questions during the webinar presentation, please feel free to type them at any time into the Q&A box on your screen, and our speaker will answer those at the end of his presentation. We ask that you don't enter the questions in the chat room if you'd like them answered by the speaker, as he won't see them. So please put them in the Q&A box. And if you'd like a recording of the webinar, we will have it in the next few days on our website, and we'll also be emailing all of our attendees a copy of the recording to watch it again at your leisure. You'll also find it on eOptions YouTube channel. We recently revamped, and we have all kinds of playlists now on our YouTube channel, no matter what level you're at. So we encourage you to subscribe to our YouTube channel and start checking into that. And for those of you just joining, we'd like to welcome you to our webinar on bullish and bearish options strategies. And to tell you briefly about eOption, as our name implies, we are a firm that specializes in option and stock trading. Our founder was a founding member of the Chicago Board Options Exchange in the 1970s and has been trading stock and options for nearly 50 years. And we charge some of the lowest rates in the industry. All of our stock and ETF trades are commission-free, and options are just 10 cents per contract plus $1.99 per trade. And something we're very proud of is our excellent customer service. At many firms, you can only trade with an app, but at eOption, you can trade through our trading platform, laptop, our mobile app, or through a live broker. And we have excellent customer support. And our professionals are licensed brokers, and most have over 10 years of experience. And you can reach out to them with any questions you have about a trade or a trading platform or a particular strategy, and they're happy to answer any questions that you have. We also offer a useful options trading tool called Options Play. And this is a tool that scans thousands of stocks each day to highlight potential option trade opportunities for you. Normally it's $500 annually, but it's free for all our customers. We also support option education, and we're glad you can join our webinar today to learn more about using options in both a bull and a bear market. And I'd like to turn our attention to our speaker now, Ed Madla, who's a principal with the Options Clearing Corporation, or OCC. Ed has over 20 years of experience in the financial industry. He started his career with Whole Trading Company, where he was an options market maker at the Chicago Board Options Exchange and the Chicago Mercantile Exchange. He then spent many years as an independent trader of stock, options, and futures. He went to MF Global and went into the futures brokerage business and then joined RJ O'Brien. In 2014, he joined the OCC, where he is today. He currently oversees retail education programs and also has a lead position in the production of options curriculum for the OCC. And without further ado, I'll turn it over to Ed Madla now. Thank you.
Thanks, Gina, for that introduction. Always good to be here with you and your team. You do an absolutely wonderful job with the services that you provide and what you have to offer at eOption, and it is a pleasure to be part of that process on the education side. As Gina said, my name is Edward Modla, so hello everyone. Thanks for joining me here today to talk bullish and bearish option strategies. I've been doing these presentations on options from the basic, intermediate, and advanced level for going on 7 years now. This is what we do at OCC in the specific division where I work, which is the Options Industry Council. This presentation here today was designed to bounce through all of those different skill levels. So we're going to be adding levels of complexity as we go along. I think there's something in here for everybody. If you're new to options and you're getting the foundation of your knowledge set, you're going to learn a lot today. If you're already there and you're already using strategies and using options in your portfolio, there will be plenty of opportunity here to offer commentary and insight that I think will be worth your while as well. First, our disclaimer: options are not suitable for everyone. They are a rather complex tool. I will have plenty of hypothetical examples today using different strategies Keep in mind, those are for educational and illustrative purposes only and should not be interpreted as an endorsement or recommendation. Here's where you can find OIC if you're interested in more of our education. First of all, we don't charge for anything. We are a free, unbiased industry resource founded back in 1992 for that sole purpose. The industry wanted a group that does not sell brokerage services or advisory services or data. We don't sell anything. We work off of the budget that is given to us by the clearing corporation. All those little clearing fees that add up every time you trade an option, that goes to the clearing corporation and allows them to do their business. They clear options, they manage risk, and then a portion of that comes to OIC to teach the product. So there's our website, optionseducation.org. We have podcast videos and webinars just like this one going on all the time. We will be teaching the Greeks next month. One of my colleagues will be delivering that presentation next month in April. I will be giving a presentation, a full-hour presentation on volatility. It's all I'm going to talk about, historical, implied. It's the type of thing we do every month, put on these webinars. And then our education team can be reached by email if you want to contact us at options@theocc.com. I do want to start here today, since we're still in Q1, still starting out the year, by looking at annual options volume over the years. Certainly had slow growth with the open outcry environment, but you had maybe this period in the late 90s, the access to information, options education, do-it-yourself investing, the electronic trading environment really caused this explosive growth, had this spike in volume in 2011. That was the year, if you recall, the European sovereign debt crisis, elevated volatility levels, and that set a high mark in options volume for a number of years, which followed that were very low volatility. If you recall, for those trading these years, I think it was 2017 when the VIX did not reach its long-term average for the entire year. It never got there. For any trading day, over the entire year. But the industry held strong, had some volatility in 18 and 19 and set these levels. Everyone was proud of getting to 5 billion contracts here in 18, almost getting there in 19. And then 2020 was really just a unique year. I'm cautious not to be a celebratory about it, because we know what happened in 2020. Not all of it was good. People were stressed in a variety of ways, but that's the takeaway for me. When the market was stressed, and when people needed to manage their portfolios in the most stressful and volatile situations, they were turning more and more to the options product. Something else we saw in 2020 was more speculating in the market as we had wider moves, particularly to the upside in the summer and fall months of 2020. A lot of call buying, a lot of speculating. And that's what this presentation today is really going to talk about, is that speculation, using options to capitalize on a directional move. And we're going to take it in a few different directions today from both the credit and debit side, but focus mostly on that long option. When I gauge investors, you don't travel as much anymore, but when I used to travel and get in front of live audiences, dozens, if not hundreds of people, and ask them, who's trading options? Who's selling options? Almost everyone always says they're selling options. When I ask who's buying options, the hands go down. And I perfectly understand why that is. Investors want to capitalize on that natural decay of options contracts. So that makes sense. And I certainly wouldn't want to sway anyone otherwise. But this is the kind of presentation that is intended to teach the other side of that. If you want to speculate, what are some different ways you can do that? So we'll just start with the very simple call and put risk profile and outline, then start to add layers of complexity. And this is where it gets interesting. We'll talk vertical spreads. I'll do all four of them. The credits and the debits are both the bullish and bearish side. And then what I call the three-way spreads. And that's going to add yet another layer of complexity. So one-sided trades, then two sides, and then we'll have three sides. And at the end of the day, when we close it up, you may think about buying options a little bit differently, because when we get to those three ways, you will actually be buying an option, whether it's a call or put, but have it constructed in a way where you are not suffering time decay. That natural day-to-day erosion does not occur, and you exchange that risk for something else. Let's get started with the simple strategies, and it's going to be first the call buying. Now back to basics 101. What does it mean when you buy a call option? You're paying premium up front. That's non-refundable. That's out of pocket. And you now own the right to buy shares at the strike price. We have an example here of a hypothetical stock. It's trading at 60, and this option is the 60 strike call option trading for $3. If you wanted to buy 100 shares, you could pay $60, and that would cost you $6,000, and you'd have this nice clean break-even point right here at 60. If you buy an option, remember an option is written on 100 shares, quoted on a per share basis. So paying $3 for this call option is actually paying $300. And that's the most you can lose. The worst that can happen is this stock moves lower. You're not long shares, so you're not going to continue to suffer losses as the long shareholder would. Instead, the option can only go to zero. That's the worst that can happen. Max loss 300. In exchange for that benefit of lower cost, lower risk, you have a higher break-even point. The stock needs to move in your favor, not only in a certain magnitude, but also in a timely fashion. So you have to be right on direction, magnitude, and timing in order to profit from the long call. Now, I always want to point out when I start to show these P&L graphs, you see here break-even point 63. Now that's the point where the option is worth what we paid for it at expiration. These profit and loss graphs, you're going to see a lot of them today, they are drawn as if we are already at expiration day. There's a reason for that. At expiration, there's no time value left in options. You're all familiar. There's an element of time, there's an element of volatility that is included in the option premium amount. At expiration, that is zero. So given a certain price in the shares of 65 or 60 or 64, we can calculate exactly what the option is worth. At expiration, if the stock's at 63, the option is going to be worth exactly $3. There's your break even. Prior to expiration, we might see the move higher quickly in the shares to 61, 62, 63. That's not necessarily your break even. You might start to see gains in this position and exit early. You can track where this premium might go using a calculator. It's one of the most common questions I get. I say, Ed, if this stock goes from 60 to 62 tomorrow, and I've still got 28 days left in this option, what's it going to be worth? Well, I don't know. What's it going to be worth if it goes to 62 a week from now? And I've got 3 weeks left in this options contract. How do I know what it's worth? Well, the answer is you don't know precisely, and that's why these P&L graphs these P&L graphs assume we're at expiration. But you can go to an options calculator. We've got one on our website, and you can type in a future potential stock price, say 62, change the days to expiration to where you're forecasting or when you're forecasting this to happen. You have to enter some volatility assumption. You can use today's level or change it a little bit up or down, and then calculate what might this call option be worth given a new stock price, given a new days to expiration, and then given some volatility assumption that you're likely extracting from what you're seeing today as far as implied volatility levels. And then you can forecast. And in fact, most options are closed before ever reaching expiration. Data consistently shows from 1 year to the next that about 70% of all options that are opened are closed before they ever get to expiration. And that's the result of investors closing for profit, potentially closing for losses, and not dealing with exercise and assignment. They get out of their position first. Another 10% of options actually go through exercise at some point, whether it's before expiration or on expiration date. And then another 20% or so of all options that are opened, 20% are held through expiration and expire worthless. And those are the kind of numbers that sometimes I don't hear from other resources in the industry who tend to say that options mostly erode and expire worthless. That really isn't true. The vast majority are closed early because that motivation is there to get out of the position rather than deal with shares, particularly if you are profitable. I'm going to spend some time here talking about puts because this gives me a chance to expand on that volatility discussion. But first, let's look at our example. We have the stock trading here at 36. You might be bearish on the shares. And for most investors that I talk to, they are likely not the type of investor who's going to short stock, or they may not even be allowed to short stock in their accounts. So they end up, if they're bearish, not doing anything. Well, the options investor has a choice. They can buy a put option. Buying a put provides the investor with the right to sell shares at the strike price. This investor has paid $225, that's $225, and they now own the right to sell stock at $35. As the share price goes lower and lower, the price of the put option will be influenced higher and higher. I won't say that it definitely will be moving higher because there could be changes in volatility going on. There could be days passing while the stock sells off. So I'll just say as the stock sells off, the put price is influenced higher and contingent on some of those other variables as well. The risk profile looks very similar to calls, just flipped around to the other side. You purchased a put option for $225. The most you can lose is $225. We have the right to sell stock at 35. Well, that's not worth anything at expiration if the stock is at that level or above. But as the stock drifts below that level, then yes, selling at 35 starts to gain value. And at expiration, we would break even if the stock were here at 32.75. That $2.25 difference between where we can sell and where we can buy in the open market today would pay us back for what we paid up front and then profits to the downside. This is bearish, or also a position that is widely said to have short deltas. I want to walk through an example that was presented to me sometime last year. And over the phone, an investor had contacted me and said that they were buying puts on stock and the shares dramatically decreased, but they had very little profit to show for it. And I always am receptive to these kinds of questions and have to do a little investigating and digging into why that might have happened or what might have been the case. Now, each options contract, each strike price has its own implied volatility level. That's what this IV is. Each strike price has its own. And if you were to plot say strike price here versus implied volatility here, you can plot where each strike price has its particular implied volatility level, and then you can connect the dots. And oftentimes when you connect the dots, I'm just going to draw a generic curve here. This is the classic implied volatility curve where the lower strike prices have the highest levels of implied volatility. And that's simply because put options at lower and lower strike prices, whether it's a stock or an ETF or an index, are often used to protect portfolios. So bids for those cheap, far out of the money, low strike puts remain elevated, not necessarily in raw numbers, but a nickel, a dime, a quarter. Those bids tend to stay there for those low priced, cheap, out of the money puts. And if those bids hold strong further and further out of the money, you get these high implied vol levels. Now back to that example. Now, what happened with this investor, to the best I could understand based on what I was looking at? Now, this stock was at about $100 a share, and they purchased the 85 strike put options. That's pretty far out of the money. If at the money is, say, right here, your at the money level is right where volatility tends to bottom out, well, maybe they bought put options right around this level, out of the money 15%, and paid a pretty steep price in implied volatility. Well, the stock had dropped down. It was trading about $87 or $88, and their position really didn't profit a whole lot. And that was where the problem was. Well, first of all, there was earnings that did come out on this particular ticker symbol. So this entire curve, if you act like this was the curve when they bought their option, well, the entire curve moved lower after earnings. Now, the entire thing, after an earnings announcement, the whole thing moved lower. So not only did they lose value because the whole curve dropped to a lower level, But if you think about it, their 85 put option, which was trading at this level of the curve, was now almost at the money. So this is what I call sliding down the curve. The whole curve moved lower, and this particular option slid from an out of the money level to mostly an at the money level. And for those two reasons, they experienced a dramatic decrease in the implied volatility level of the option they owned. And that was a major reason why they did not profit. Also, their option didn't even go in the money. It was still a few dollars out of the money. And this investor had expected a tremendous increase in time value without really understanding just how big of a decrease in implied vol they would have to endure after earnings and after the stock moved. Now that's a lot there on volatility, but it's relevant when you're trading puts and calls because as the stock moves, the option you have is going to be moving around to different points of this curve. Now I should say this structure, this curve you're seeing here is the classic, most commonly found implied vol curve, but not necessarily the case across all ticker symbols. You could have flat curves that go where equal implied vol levels for calls and puts. You often tend to see that for commodities, say gold or crude oil or corn. If you're trading futures, you'll see more flat vol curves as the speed in either direction can be just as fierce. So you can see flat curves. You can also see inverted curves. I mentioned at the top, in 2020, there was a lot of speculating. There was a lot of call buying. And I saw more inverted curves with call vol levels higher than puts more often than I had ever seen before because a lot of call buying was going on. And that is still going on today. If you're seeing the headlines of different trades that are occurring, there is a lot of call buying going on, driving premiums of calls higher and inverting these curves, which normally you would say is a very rare occurrence. But in this environment, and it has been for the past at least 6 months or so, seems to be more and more common. Let's move on to add that second piece. We talked long calls, then we got into long puts. Let's add the second leg and walk through the 4 different vertical spreads. And we'll start with the bullish verticals. I'll do both of them, the debit and the credit. Do the same thing for the puts after this. First of all, for the bull call spread, this is the debit version of the bull vertical, buying a lower or higher strike, higher premium, lower strike, higher premium call and selling a higher strike, lower premium call option. You start with the same motivation. The long call is going to drive profitability. That's what you want to own. Stocks at 90, you're bullish, you want to profit on a move higher. So you buy the 90 call. But instead of paying 205 and risking that entire amount, you go to a higher strike price and you sell another option. Now you have the right to buy shares at 90 and you're obligated to sell those shares at 95, but you receive some premium for that, lowering your net debit. If both options expire out of the money, you only lose $1.35. And in this case, in exchange for that lower cost of entry, you cannot make more money above your higher strike price. Max profit would be if you're right and the stock moves up above the 95 level. You have the right to buy shares here at 90. You're obligated to sell them at 95. So you'll be taking $5 out of the market minus your cost of entry, and there's your max gain. Now, when it comes to constructing these spreads, I tend to start with the short strike. I find it easier to start by selecting the short strike. And I define that approach by saying that the short strike is generally the stock level that you believe the stock might get to, but is not going to go through. And so that might be easy to remember. It'll get to, but not through, or it will reach, but not breach. It's that level that you think is sort of the maximum move that is going to occur, but no more than that. If that's correct, then you will have gained as much as you possibly could out of the 90 without having to give anything up above that. That obligation to sell shares here really wouldn't have cost you anything as long as the shares don't go above that. And you're trying to sell that level to get as much premium as you can. Of course, you can sell the 100s, and that's going to give you more room You don't have to give your shares away until 100, but the premium received on the 100 call is going to be far less. So that's what you're doing, selecting that level you think the stock's going to, but not going to go totally through. There's your short strike. Now, of course, part two of that analysis is actually looking at the premium. Some of you may say, well, it's not worth it to sell 70 cents. I need more than that. So you look at the 94s or 93s, or maybe you just don't do the trade. But you have to look at the premium as well. So the level has to be right where you think the stock's not going through, but also the premium has to be worth your while. Once you have that short strike in place, then you can start to investigate. I know the stock's at 90. Well, what's the cost? What's the risk profile look like if I buy the 90s or the 88s or the 87s or the 92? And you can look at different strike prices and figure out what fits best. The other thing I'll say about these verticals, I'll continue to say this as we walk through them, is what happens if you're in between the strikes? We know that if the strikes are out of the money, everything expires worthless. We also know if both strikes are in the money, then they'll both be exercised and assigned, and we'll have no position. But what about in between? And this is where position management is paramount, and this is why options traders are normally not set it and forget it type of investors. They are active and they are managing positions and monitoring them all the time. If the shares are in between 90 and 95 and you do nothing, let's say shares are 91, 92, and you don't do anything at all, at expiration, it is very likely that your firm will exercise the 90 calls while the 95s expire worthless, and you now own shares of stock. You have to pay for those shares, and your risk profile would be very different. Your risk of loss would be much greater because now you simply own shares of stock. You don't have that controlled risk that you had when you had the options piece in place. Now with the bull verticals, I consider that a viable decision to be made. If the stock is, say it's trading 93, 94, it's possible that your opinion has changed. And now that the stock is moving higher, you are more bullish and you're comfortable owning shares. So you accept the exercise and you take on the shares and you pay for them. That's something you could decide to do. Most investors won't do that. They're in options because they didn't want shares in the first place. So if you do not want the shares and the stock is in between the strikes, you need to close out your 90 calls. Just sell them. Sell them for whatever you can, hopefully for more than the $1.35 you paid for the spread, and have some profit, and then move on to the next trade. Now here's the bull put spread. So same direction. We're still on the bull side of the verticals, but we're going to do the puts, which means we're selling puts. We're not going to buy them. Buying puts is bearish. So we're going to be selling puts as a credit spread, and that's going to be your bull put vertical spread. Selling the more expensive higher strike put and buying the less expensive lower strike put option. Stock's here at 115. And again, investors are normally not going to be shorting shares of stock. Or in this case, it's bullish. So stock's at 115. We think the shares are going to move higher. And so we reach, we'll just do at the money, sell the 115 put for $2, buy the 110 put for 70 cents. And there's your $1.30 net credit between the two. Just remind ourselves what this means. We sold the 115s. Obligated to buy shares there. We bought the 110s. We have the right to sell shares there. If the stock drops, that will happen. We'll pay 115, we'll sell them at 110 and give back $5 to the market. We were paid $1.30 up front, and there's your max loss of 70 cents. While this spread exists and has been constructed, the max loss here, $3.70. If the options expire worthless, and expire out of the money, then we simply keep the max profit, the credit we received up front, which is $1.30. In between the strikes, same explanation as that call vertical spread, the bull call spread. You can think about it. You can decide if the stock's trading 111, 112. Do you want to buy shares? You're going to get assigned, pay 115. Your cost basis is going to be 113.70, and you'll own stock. Do you want that or not? If you don't want that and you can't tolerate that assignment, you have to exit this position. buy to close the 115 put before the closing bell of the trading day. Most likely this is your expiration day. You buy to close before the closing bell and eliminate that position, get rid of that open assignable position, then you don't have to worry about buying shares. But here on the bull side, maybe it's something you consider. Different story on the bear side as we walk through the two bear verticals. First, the call spread vertical. This is credit spread. So we're selling options, sell the more expensive lower strike call, buy the higher strike call that costs less. We have the stock at 50, sell the 50 strike call for $1.65. Now, if we didn't do anything else, that would be a naked call option. That is the highest risk options trade that you can take on. It has a similar level of risk that shorting stock does. As the stock goes higher and higher and higher, you lose more and more. But it is not, does not have as profitable a risk profile as shorting stock, because if you are short shares and the price corrects, you profit more and more as the stock moves lower. But with the call option, the most you can make is what you sold it for. So that risk profile is something I don't see a whole lot of investors doing, selling naked calls. But here you're bearish, so you sell the naked, you sell the call for $1.65, and then you reach up to cover that risk, to cover all of that upside risk. You go up and buy the 52 half strike for 65 cents, collecting $1 in premium up front. There's your max profit. If both options expire out of the money, max gain is $1. If the stock goes above the higher strike price, both options are subject to exercise and assignment. You are short the 50 call, selling shares at that level. You're long the 52 halves. You can buy them back there, giving $1.50 back to the market. We received $1 up front. There's max loss of $1.50. Break even point is 51. And this is one of the dynamics between credit spreads and debit spreads that you may have noticed as I'm got one more to go here. But when you are selling options, and in this case we're choosing at the money and out of the money options for our strike prices, the max gain is less than your max loss. This risk profile doesn't look all that great because we can lose $1.50, we can only make $1. And when it's a debit spread, it's the opposite. And we're going to see that on the next slide when I go through the final vertical, which is a debit spread. The max gain is more. And the reason why that is because your break-even point is so much better for the credit spreads. Here in this case, the stock's at 50. If the stock doesn't go anywhere, we make our max gain. If it moves the way we expect it to, we make our max gain. We can actually have, in this case, a 2% move in the wrong direction against us before we reach our break-even point. So we're profitable at all of those levels: a neutral market, a bearish market, or even one that very, very slowly moves higher. We don't lose until, in this example, the stock moves more than 2% in the opposite direction than we thought it was going to go. For that wider range of profitability, and the ability to profit if the stock doesn't move at all, and even if it moves slightly against us, you will have this profit versus loss that is skewed against you. So let's take a look now at that final vertical spread. The bearish side still here with puts. So we're buying puts. We're going to have a debit spread, buying the put spread. Here we buy the higher strike, more expensive put option and sell the lower strike, less expensive put option. Stock's at 90. We buy the at the money put for 350 and decide to reduce our cost by selling a lower strike, lower price put option for $1.80. And now we've reduced our cost significantly, only paying $1.70. If we're wrong and the stock moves higher, we lose $1.70. If we're right and the stock moves lower, we need it to move lower in a timely fashion and of a certain magnitude. And if we can get that correct, we have the potential to pull $5 out of the market. We own the right to sell stock here. We're obligated to buy it back down here. That's taking $5 back out of the market. Best case scenario, minus our cost up front, and there's your max profit. And here you can see max profit is almost double what the max loss is. And that's because stock's here at 90. Remember with the credit spread, the stock could consolidate. We made money. Stock can move in our favor, we make money. Stock can move slightly against us and we still make money. That's not the case with the debit spread. If the stock does nothing and stays neutral, we lose. If the stock moves in our favor, well, we need it to move in our favor just to break even. We don't have that break even point on the other side. We need it to go there just to get our money back. So a clear difference between the credits and debits, a likelihood of success, where those break even points sit, and then in exchange for that risk or that profitable range, the max profit versus loss is going to be different between the credits and the debits. Stock in between strikes for the bear verticals, very different from what I said when I was speaking about the bull verticals. In this case, if the stock is in between the strikes here at 88, 87, 86, the 90 strike option is subject to exercise. The 85 is going to expire out of the money. And if the investor does absolutely nothing, then they would be short stock. And again, they might not even be allowed to do that. This is a situation where you may have forced liquidation of your position because you can't take on a short stock position. This requires position management. And I would say the overwhelming majority of the time, if not every time, I speak to investors about these bearish verticals. If the stock is in between the strikes, their intention is to get out of the trade. Just close it and move on to the next trade. In fact, that brings me to one other sort of point of concern is we always try to teach as much about the risks of the product as the benefits. That's the way people are going to use them the wisest. And that leads me to speak about what if the option is really close to the 90s or 85s, particularly the 85s, sitting right there, 85.01, 85 even, 84.98 at expiration. When you get your strike that close to where the stock is at expiration, and it's a short option, you really don't know if you're going to be assigned or not. It's up to the option holder. It doesn't matter if the stock has closed above or below 85. The owner of the 85 put can do whatever they want with it. And I hear this from investors who are fairly new to options. They will say, well, look, the stock closed down at 84.70, 84.80. I figured I was okay. I was going to exercise my 90s, get assigned on the 85s, and have no position. All of a sudden, I was shocked. I didn't get assigned. I've got short stock. I'm not supposed to have that. You do need to be aware of that. The owner of the 85 put, the owner of any option, can watch after hours activity and decide, do I really want to exercise this option or not, regardless of what the closing price of the stock was at the closing bell of expiration day. And that's particularly true when you're within pennies of a particular strike price, or if you have an underlying that's very volatile. My 24 years in this business, it hasn't happened too many times, but I couldn't count the number of times on my fingers. It's been more than that, where I've been surprised by getting assigned when I didn't expect it, or by not getting assigned when I expected it. And it doesn't happen often, but it can happen. Now, the same dynamic is true with your 90 strike, but remember, when you're long the option, it's up to you. You have the decision. And you can contact your broker whenever you want and say, I know the option's out of the money. I want to exercise it anyway. Or the opposite. Yes, I can see this option expired in the money, but I didn't like what happened after hours. I don't want to exercise it. I don't want it. You own that option. You have the right to decide what you want to do. But when you're short, you don't have that choice and you have uncertainty. That's what's called pin risk. You've heard that term. When you're short options, stock is right there at the strike. You don't know if you're going to get assigned or not. There's some level of uncertainty. That's pin risk. You don't know what your position is going to be. And that's when it's more imperative to potentially just close this thing out. Get rid of it, sell the spread for what you can, close out your 90s, close out your 85s. Don't worry about exercise and assignment with no positions, and then move on. Now that takes me to sort of the culmination of this presentation with our three-way spreads. We've talked calls and puts outright and why you would want to buy each directionally. And then we got into the verticals, which added an element, but for the debits at least, the long call and the long put within the debit was driving profitability. And I want to stick with that theme as we add this layer of complexity into the three-way spreads. I'm just going to set up a hypothetical example, and then we'll put up a risk profile and talk about it. Regardless of how you're analyzing the market, technical analysis, fundamental analysis, you're listening to your neighbor, you pay for an advisory service, whatever it is, you believe that a company is poised for a share price increase. You're bullish. And when you're bullish, there are different things you can do. You can buy shares. We walked through buying a call already. You can buy a bull call spread. That's the bullish vertical spread. We talked about that. You can sell a bull put spread as well. That's a bullish vertical spread on the credit side. Of course, there are other things you can do, but here are some choices. And maybe I'll pause for a few seconds here. I'm going to put two of these together to create a three-way so I can profit on the upside, but I don't have to suffer from time decay. So I'm going to pause, just look at those four and see if you can figure out which two am I going to put together. Well, hopefully you are, first of all, I'm going to be sticking with the options side. So I'm not going to deal with shares of stock. I don't want to buy shares. That's going to cost too much. I want to enjoy the benefits of the call, but not suffer from time decay. So I'm, of course, going to be merging a buy and a sell together. And I'm going to put together buying a call option with selling a put spread. Two bullish trades combined into one. I'm going to call it the three-way, and you'll see how this looks. Now, the driving force behind the trade, profitability is going to come from this long call. That's what I want. I think the shares are going higher, and I want all the benefits of the long call. I just don't like to pay for options because I don't like the fact that they erode every day. That's what we're doing here. That's what we're trying to solve. So I'm going to compare how this three-way looks on a profit and loss graph with just simply buying the calls. This is the trade that, again, certainly there's a lot more call buying going on in today's market than I had ever seen, and a lot of investors are doing well with it. But this is the trade that many times investors shy away from because of that erosion and time decay factor. Buy say the 110 calls for $4.30, you get your risk profile. Anywhere below that 110 level, the option expires worthless, and above 110, you start to make money. This is the driving force behind our profitability of the three-way, but we just don't want that theta risk, the time risk. So we add the pieces. We buy the 110s still for the $4.30, but we add this vertical put spread to it. Two bullish strategies combined into one, three pieces. And in our example, we sold the 100 puts for $6.10 and bought the 80 puts for $1.30. And stock at this point here, going through this example, the stock's just above 100. So slightly out of the money puts, and a little bit out of the money calls. Slightly out of the money puts we sold, and then we reached down and bought those puts down below. Now compare how this looks on the P&L graph. If everything expires worthless, meaning the stock is between the 100 and the 110 level, then we really don't have anything. Now we did this three-way in my example. When I calculated this, I was able to get a 50-cent credit, but oftentimes, when I'm putting these together, I'm looking for even money, and that's roughly where you're going at least for starters, is even money to do all three pieces. If it all expires, if every option expires out of the money, you get nothing for it, and it just expires worthless. Now, if the stock rallies and goes your favor as you hoped it would, then you can suffer some gain. You can enjoy gains to the upside, not just on the calls that you own, but also the fact that you have another bullish trade, this vertical spread, that's going to erode down to zero. So you have both of those strategies working in your favor. That's why the upside is even better. So even better upside, much better here if the stock consolidates it's around its current level or doesn't move very much. Remember, if you just bought the calls, you'd be suffering losses in time decay. Here, if you're doing the trade for even money, there is no time decay. You don't have a debit. You don't have anything to lose. So you just lose nothing in between those strikes. It's once you get to the short put strike, here, that 100 level, once you go below that, now you're giving back to the market. Remember the vertical put spread, that credit spread that we walked through? Once you go below the short strike, you're now giving money back to the market. And you'll give money back to the market until you reach your long put strike, and then you're covered. And that's where I'll focus here. You have some great advantages, all the benefits of the long call, none of the time decay, a much better break-even point, but what you have is significantly greater potential loss. You didn't receive a credit for this put spread. You used that and you bought the calls. So your net was nothing. You had no credit. When we walked through the vertical spread, the credit on your put spread somewhat buffered your losses. But in this case, that's gone. You don't have it anymore. And that's why you have such a larger loss to the downside. In this case, virtually that entire width from 100 to 80 is your potential loss. Much, much greater loss potential, but for some significant gains. Long an option, all the benefits you can enjoy from that long option, no time decay, no theta risk. Now, this is one of those trades you would likely be looking to unwind or exit early if you get a chance to do so. I'm saying no theta risk. That is true. No theta risk, at least that you would lose money because you didn't pay anything up front. But remember, theta is greatest for at-the-money options, and your time decay is greatest for at-the-money options. So if the stock starts to move that 110 level and your $4.30 option starts to increase in value, all of a sudden you will develop some theta exposure, not risk of losing and going negative. But if the stock goes up to, say, 110 today or tomorrow and sits there, then your 110 calls is going to start to erode with each and every day. And so theta exposure might be something you encounter if the stock moves in your favor. I'm going to walk through this three-way again from the put side, because there's kind of a lot here to digest, but really it's just taking two bullish trades, long call and credit put spread, and just putting them together. And when you do that, if you can work out these premiums to be about even money, then you drastically change the risk profile. So you're not suffering from time decay. You don't have to worry if the stock's not going anywhere, it's moving slowly. You don't have to worry as much about that. You've exchanged that theta risk for directional risk, or for those familiar with Greeks, you've exchanged theta for delta. And if the stock moves against you, you can suffer those big losses. Let's look at the put side. I'll spend a little bit less time on this because it's going to look the same just from the different perspective. Here again, for whatever reason, you expect a share price decrease and you're looking to pick up some short deltas. There's different things you can do. Sell shares short. Well, you know, we're not going to do that. Buy a put option. And then you have your two verticals that we looked at earlier. Well, we want the put option. We want to profit and enjoy all the benefits here of the put option, but not pay for it. So we're going to combine the two of buying puts and selling the bear call spread and see if we can achieve the same thing. And certainly we will. So here's your driving force behind profitability. The 95 puts trading for $4.30. If you bought that outright and that's all you did, then certainly you would suffer losses and be suffering from time decay if the stock didn't move in your favor. If it consolidated, if it started to move up, your premium is gone. The three-way, it looks congested when I put it up here, but again, it's not too complicated. I'm just taking the long put and I'm overlaying the vertical credit call spread to it, selecting strike prices so I can mostly get an even money trade. That's where my strike selection comes from. I'm trying to do something for even money or very close to it, so I have eliminated time decay and any debit. And in this case, worked out all the premiums to come out to a slight credit. That's not so important. If you're around even money, that's what you're looking for. And now if the stock consolidates in between the put strike that I own and the call strike that I sold, and everything just expires worthless, then the trade's a scratch. I don't make her lose anything. If the stock sits right here, if it's trading, say, at 100 today and it just does not move, I don't lose anything. And that explains no time decay risk from one day to the next as the trade is constructed. If it goes my way, I'm really making money on both of these trades, the long put and the credit vertical spread. So I enjoy a little bit greater profits to the downside and all the benefits of the 95 put. I keep making money as it goes lower. And what I give up for those benefits, and I consider those significant benefits, what I give up is much more potential for loss if I am completely wrong. And not only does the stock not sell off and not consolidate, it moves the other way in a big way. And if that happens, then you can suffer some big losses here. Now, these premiums and these strike prices, I used hypothetical open market values and calculators to come up with them. The reason why I did that is because this is fairly typical for a moderately priced, say moderate, an equity with mild implied volatility levels. This is a realistic looking breakdown of strike prices. And I'm pointing that out because to get something at even money, it's not going to be so easy to do unless you widen that spread. And from executing these trades so many times over the years, I can tell you, when you start to put it together, if you find an underlying, you're thinking, hey, this thing's really going lower or it's going higher. I just don't want to pay all that for that call or put, so I'm going to overlay this vertical. When you put this together, many times, the strikes that it's going to require to get even money are likely not as good as you hoped they would. And I've found that to be inevitably the case when I put something together. Like, man, I really wish I could get a better strike for the put that I own, or I wish it didn't have to go that wide in the vertical that I'm selling. That's likely what you'll encounter here. But the benefits of the trade are still there, and somewhat on your risk tolerance, but also on your confidence level, that may lead you to one direction or the other. A little bit complicated, I would say, on the three ways in the P&L graph. It's got all these twists and turns to it. But again, breaking it down into those two simple pieces, all you've got here is a long put and a vertical credit spread. That's really it. One of the questions I often get about this is this a short-term or a long-term trade? What would you say? And certainly any option strategy can be either a short or long-term trade. It partly depends on your market analysis. Where do you think the stock's going and when do you think it's going to get there? That may lead you to one expiration duration versus the other. But I don't mind saying that this particular strategy tends to lend itself for longer dated options. If you're going out 3 months, 4 months, 6 months, since you've got that long option, whether it's a call or a put, you've got all the time in the world to let that trade go and keep going for you. Let it run. Let's see if you can get a big move in the stock over a longer period of time. And again, you don't have to worry about theta. You just got to worry about direction. You got to worry about the stock moving the wrong way. More time gives you a little bit more flexibility to be a bit wrong on the direction. Maybe it makes a quick move in the wrong direction, then turns around. Gives you more time to be right and gives you more time for that long option to really start to profit for you. So I think this three-way lends itself a little bit better to that longer dated expiration. I'm going to see what kind of questions you guys got for me, but I'm going to put this up while I address those, just to let you know where you can find us. Again, the investor education team, options at theocc.com, our website, optionseducation.org, and webinars just like this one. You can find a list of upcoming events in our events section of the website at optionseducation.org. Looks like we had a wonderful turnout today, so I want to say thanks to everyone for joining. A huge crowd today. Wonderful to see. I've got time for a few questions. Let's see what we've got. Did you say you can sell options after hours? No, I did not. You cannot sell options after hours. Closing bell goes off. Options are closed. That's it. You can't sell them. And I believe what this question is referring to is when I was talking about after hours activity, I was referring to an option holder who has the ability, after the market has closed and the closing bell goes off, they can watch after hours movement in the share price, and that movement can lead them to a decision on whether or not they want to exercise their long call or put. A stock can make a big move after hours. And if the stock is particularly close to a strike price, it could easily move above or below a particular strike price during after hours activity. And an option holder watching that might decide, well, yeah, I know where the stock closed when the closing bell went off, but I see where it's at right now after hours. I want to exercise it or I don't want to exercise it, using that after hours activity as a little bit of a gauge. That's what I was referring to with after hours. I did not say, and I will, will repeat, that you cannot sell after hours. After the market has gone off and the options exchanges are closed for the day, that's it. No after hours trading. How do you decide, between all of these strategies, which is the best to use? I get this question a lot. Which one is the best? Now, I've got a pretty healthy toolbox of option strategies in my pocket, and so I always answer this question the same way. Strategies, they work as advertised. Option strategies are defined a certain way, they're priced a certain way, and you're gonna get what you pay for, what you receive. So for me, it's not a matter of saying, well, this is the strategy that's the best one to use. I am really someone who looks at things on a case-by-case basis. There are times when maybe it is most prudent to just buy a call. There are other times when maybe the bull call spread is the way to go, or the bear call spread, or whatever it might be, the three-way. I'm willing to do all of these trades. It's the situation that will lead me to the strategy. Most of the time, it's my confidence level. How confident am I in this trade? And do I have a sense of how long it's gonna take for this stock to get where I think it's gonna go? Those pieces of information are gonna help me decide what kind of trade do I wanna do. Buying a call is really aggressive. You've gotta be right, and you have to be timely, and it's gotta be in the right direction. And if you are right and the stock rips higher, buying the long call is gonna be a wonderful trade for you. Using the verticals is going to be muted. You're not going to make as much money there, but you might choose the vertical if you're not so confident. If you want to reduce your risk, you want to improve the structure of your break-even point, you use the vertical. Give yourself a little bit of a risk tolerance there. The three-way is the most aggressive. In one respect, anyway, you're taking on much greater risk if you're wrong. But remember how that three-way played out. You're not taking that theta risk. So if I think, well, maybe this stock, it might not go higher, but it's certainly not selling off from here. For whatever reason, I'm feeling like, listen, I'd like to buy the call option. I think it's going higher. Maybe it consolidates. I don't know when it's going higher. It's trading at a low multiple. The stock is dirt cheap, but I just don't know when it's going to move. But it certainly isn't going lower than this. The stock is just trading at too low of a level. Well, maybe that leads me to the three-way, because now I don't have to be concerned about time decay. I can buy the call. I can capitalize on the upside. I can sell a put spread on top of that and not be concerned about the downside, because my market analysis has led me to that. So the strategies work as advertised. It depends on what you're trying to accomplish that will lead you there. So suggestions on how to forecast where a stock might be headed. Well, that's a tough question. Certainly that's out of my area of jurisdiction. I don't talk about market analysis because there's so many different ways to do it. I'll just say most often, certainly investors can follow whoever they want to follow. They can take guidance from whatever sources they wish. For the investor that's doing it themselves, I most often hear that investors participate in some self-study to learn certain technical analysis tools that they are comfortable with and they find confidence in, but to also combine that with some type of fundamental study. So for example, these are not endorsements, but maybe an investor, they like support and resistance levels and trend lines and moving averages when they're looking at a chart, and they develop some sense of where the stock might be headed. And then in conjunction with that, they're looking at the forward multiple and the gross margin of a stock. And they have a few pieces of that fundamental studies to sort of back up their opinions. And if they all sort of align in the same direction, then they have an opinion on where the stock's going. And when you use those technical studies, you have a much better chance versus the fundamental studies to identify strike prices and expiration dates. But really, it comes down to combining some things and choosing what you feel best. In your three-way, what is your expiration date? Yeah, I try to address that. I left that off the slides. What was my expiration date for those three ways? When I put that trade together, I think it was about 10 weeks till expiration, but I didn't want to focus on that when I outlined the strategy. So it's certainly a good question. When I was walking through my commentary there, I really would say that while you can use weeklies, you can use a monthly, those three ways really seem to lend themselves better to that longer term trade. And I believe when I typed up those premium amounts, I was looking at about maybe 10 weeks till expiration or so. But oftentimes with that three-way, you're going out even further than that. You can be going out 6 months and putting on that three-way. Lots of good questions. We're already a minute over time. I apologize for going a little bit over, but the questions are good. The feedback is always nice to see. And again, the audience size was wonderful. I will hopefully be able to come back and give another session in the near future. But until then, to wrap this session up, I'll turn it back over to you, Gina.
Great. Well, thank you so much, Ed, for that informative session. And thank you to all of our attendees and for all of your excellent questions. We did have a very large turnout today, and we greatly appreciate it. If you do have any additional questions, you can feel free to reach out to our trade desk at any time, and they'd be happy to answer them for you. And we did have a few people post questions in the chat room asking about recordings of the webinar, and it will be posted to our website later this week at eoption.com. We'll also be sending each attendee a recording of the webinar, and it'll be on, and so you'll be able to view that at your leisure. And as you can see on the screen, we hope you'll mark your calendars for our next webinar on Wednesday, March 17th. That's 2 weeks from yesterday at 1 p.m. Central Time, and it's Soar Through Market Volatility with Iron Condor Spreads. And the link to sign up is eoption.com/webinars. And that is hosted by a professional trader with over 30 years of trading experience, and he will take you through real world examples. So we hope you'll mark your calendars for that. Next, we hope you'll go to eoption.com for more option strategy resources. We have tremendous resources on our website, and if you haven't checked it out, we encourage you to. And if you like the content today that Ed talked about and want to learn more about bull put spreads or bear call spreads or theta, we do have clickable strategy links from the OIC that have descriptions when you use it, videos. So we strongly encourage you to go to eoption.com and check it out. We also have all of our past videos and webinars on there as well. So you can learn lots more if you're interested in different strategies, spreads, covered calls, it's all on there. And if you're interested in opening an account, you're not an account holder at eOption, you'll find links at eoption.com as well on how to get started with us. We do offer unlimited commission-free stock trading, and options are just 10 cents per contract plus $1.99 per trade. And like I said at the beginning, one of the things we pride ourselves on is our live expert professional support team and our trade desk. We know so many other trading firms, you can only use an app and it's impossible to speak to a live person and you have to wait days to get a response. But that's not the case at eOption. Most of our staff has over 10 years of trading experience, and they're happy to answer any questions you have, whether it be on an option strategy you heard today, how to use our trading platform, some of our free tools that we offer. They're happy to walk through any question that you have. So we hope you'll check out eOption and give us a look and check out the website. And last, you'll see the third point is we hope you'll subscribe to our YouTube channel at youtube.com/eoption. We just recently revamped it in the last month, and we have all kinds of playlists no matter what you're interested in. So if you're interested in option strategies or a specific type of spread, or trading earnings season using options, we have about 12 different playlists on there that you can click on and see all of our videos. So we encourage you to subscribe. And also, whenever we post a new video on there, a webinar or something about our service or anything, that'll go on YouTube and you'll get notified if you subscribe. So we highly recommend that you go there and check it out. So that's all. And thank you again for your time. Again, we greatly appreciate it. And be safe. And we hope to see you on March 17th at our next webinar. Thanks so much, and bye now.